The topic for this video is Module 4, Investment Instruments, Chapter 10, Equity Securities for the CFA Institute Investment Foundations Program. So here we are in Module 4, Investment Instruments, moving on to Chapter 10, Equity Securities. There's 5 learning outcome statements for this chapter, but as you can see, there are 72 practice questions in the learning ecosystem, which is the most for any chapter, but don't worry, it's not too difficult. So the 5 learning outcome statements for this chapter are, after completing this chapter, you should be able to do the following. A, describe features of equity securities. B, describe types of equity securities. C, compare risk and return of equity and debt securities. Learning outcome statement D is describe approaches to valuing common shares. And finally, E, describe company actions that affect the company's shares outstanding. So before we get into the learning outcome statements for this chapter, I just want to give a bit of a bigger overview of equity securities. Some of it I'm using from CFA Level 1 content, some of it's my own, but I just want to complement the CFA Institute Investment Foundations program with a little bit of extra information, okay? So on this first slide, this is straight out of CFA Level 1 text, which I can show you in a minute, and it's starting the chapter for equity securities. And it says equity securities represent ownership claims on a company's net assets. Assets minus liabilities equals equity, okay? And so stocks are equity. As an asset class, equity plays a fundamental role in investment analysis and portfolio management because it represents a significant portion of many individual and institutional investment portfolios. So the study of equity securities is important for many reasons. First, the decision on how much of a client's portfolio to allocate to equities affects the risk and return characteristics of the entire portfolio. Second, different types of equity securities have different ownership claims on a company's net assets, which affect their risk and return characteristics in different ways. And finally, variations in the features of equity securities are reflected in their market prices, so it is important to understand the valuation implications of these features. Okay, what I'm showing on this slide is the growth of $1 from 1926 to 2017. It's USA data, and I'm getting this from the Ibbotson SBBI yearbook. This is something that's published year after year, and it gives information on asset class returns, in particular stocks, government bonds, treasury bills, and inflation. So small stocks in this example are represented by the Ibbotson Small Company Stock Index. Large stocks are represented by the Ibbotson Large Company Stock Index. If you want more information, you can kind of Google search. Government bonds are represented by the 20-year U.S. government bond, treasury bills by the 30-day U.S. T-bill, and inflation by the Consumer Price Index, which is something that we looked at in the chapters on economics, okay? So again, if you Google search Ibbotson SBBI yearbook, this you can usually find a PDF for this publicly on the internet, okay? So what it's showing here is that the compounded annual rate of return on small stocks from 1926 to 2017 has been 12.1%, okay? And on large stocks, 10.2%. And a lot of times when you talk about people's expectations, in terms of investing in stocks, what your expected return is, you often hear 10%. And that's one of the things that I point out. It's kind of based on long-term historical compounded annual returns that if you look at large stocks for the U.S., whether you use this, Ibbotson Large Company Stock Index or the S&P 500, it's going to come out fairly close to about 10%, okay? So what this is showing is that if you started with $1 in 1926 and the money is continually reinvested, how much would you have at the end of 2017? And so it's showing the different growth rates. Inflation on average was 2.9%. Treasury bills gave a annual compounded return of 3.4%, and government bonds 5.5%, okay? So you can see here with regards to the stocks, if you invested $1, this is hypothetical, it's for illustrative purposes. If you invested $1 in 1926 in the Ibbotson Small Company stock index and all the earnings were reinvested, at the end of 2017, you'd have $36,929. Okay, and so that's illustrating a couple of points. Number one is the power of compounding. That's something that we saw in the quantitative concepts chapter. And another thing, just to show you, recall that future value equals present value times 1 plus the interest rate to the power of n. So 1926 to 2017, 92 years. So if you did future value equals 1 plus 12.1% to the power of 92, the future value, which is what we learn in quantitative concepts. Now, you're not responsible to do the calculations, but I just want to show you this is how a lot of the quant leads into, investment management. The future value would be 36,619.83, which is with about, that's just a little bit of rounding, $300 within, 36,929 here, okay? So when you see here, a compounded annual return, 12.1%, $1.1926, using our quantitative concepts, future value equals present value times 1 plus r to the n. Future value is that $1 times 1 plus 12.1% to the power of 92. Future value equals 36,619, okay? So, but the key message that is coming out of this is that if you want to grow your capital, then you want to be invested in stocks, okay? If you invest in T-bills, you can see you're just protecting your purchasing power over the rate of inflation. So if you invested in T-bills in 1926, you'd end up with $21 at the end of 2017, and inflation was 3.4% versus the 2.9% on inflation. Now, if you put $1 in your drawer in 1926 and you pulled it out of your drawer at the end of 2017, you'd have no growth, and so the purchasing power, you could see, would be diminished. And following higher return than the T-bills but lower than the stocks is the bonds. You can see that long-term, on average, the compounded average return on the government bonds was 5.5%. So that has implications when we talk about building a portfolio. If an investor's objectives is growth of capital, you'd be investing in stocks, okay? If the investor was very conservative and just wanted to protect the purchasing power with a lot less volatility or risk, then they would be looking at putting more of their portfolio into bonds or T-bills. So it's important to understand, why people invest in stocks. And you can see from this data from the Ibbotson SBBI yearbook, the big reason is that long-term on average, it provides growth of capital. Now, the previous slide was talking about returns, but when we talk about returns, we also need to talk about risk. So risks is investing. This is the definition of risk out of the CFA program. It says greater variability in market prices and cash flows can be thought of as commensurate with increased risk, because an investor owning a risky asset with a highly variable price pattern faces having to sell it for a more unpredictable price than a less risky asset. The assumption that variability in asset returns represents risk, and that the premiums over what could be earned on a riskless investment represents the price of risk, is the foundation for modern finance theory. So it should be stressed that when analyzing investments, returns provide us with only one half the information we need. Information on the risk characteristics of investments are equally important. We measure risk by calculating variance and standard deviation. So again, that's why we're building on what we learned in the quantitative concepts. So again, I gave the formula there for variance and standard deviation for both a population and a sample. If you're following these videos in order, then you'll know that you've seen that in the chapter on quantitative concepts. Okay, so this is to 2012, not to 2017. I haven't updated that, but that's fine. You can see that I just wanted to show you that, comparing 2012 or there's 2017, the numbers for the returns weren't fundamentally very much different. Okay, so this again was from the 2012 Ibbotson SBBI Classic Yearbook, and this used to be exactly in the CFA Level 1 reading for equities introductory chapter, but they've changed it a little bit, okay? So you can see here the asset class, I've got stocks, I've got bonds, and I've got cash here, and that's the traditional asset class. The traditional asset class for a core portfolio is stocks, bonds, and cash. But the stocks, they break up to the small cap and the large cap, and the bonds, they had long-term corporate bonds, long-term treasury bonds, T-bills, and then the inflation. You can see the inflation was at 3%, and the small cap stocks 11.9%, large cap 9.8%. So that's fairly similar to the previous slide that we just saw with regards to the returns. But as we said, returns is only half the information. We need to look at the risk. So if you look here, the risk, measured by standard deviation, the higher the return, the higher the risk. Okay, so the standard deviation for small cap returns was 33%, the large cap returns 20.9%, and then the bonds, lower return, lower risk. So we often plot that graphically. On the y-axis we have return, and on the x-axis we've got standard deviation, and it's an upward sloping curve. Okay, the lower the risk, the lower the return, and that's typically the trade-off in finance. So again, understanding the return and risk, or risk and return characteristics of the different asset classes is really important when you start building a portfolio and making an asset allocation decision. So here's some quotes from Jack Bogle on strategic asset allocation, and his whole message is about simplicity. Stick to simplicity. So he says, don't complicate the process. Basic investing is simple, a sensible asset allocation to stocks, bonds, and cash. Perhaps the most critical decision you face is getting the proper allocation of assets in your investment portfolio. Stocks are designed to provide growth of capital and growth of income through dividends, while bonds are for conservation of capital and current income. So we saw that. That's why I like to look at the data from the Ibbotson SBBI yearbook, because when it says stocks are designed to provide growth of capital and growth of income, we look at the historical data, and that's the case. No asset class has provided better capital gains than stocks in general on average, okay, over the long term. So once you get your balance right, then just hold tight, no matter how high a greedy stock market flies, nor how low a frightened market plunges. What he's saying there is that it's very difficult to time the market to be very active, okay? So the key decision is getting your proper allocation of assets, your strategic asset allocation. And change the allocation only as your investment profile changes. And so back in 2012, he said the paradox is that in these times of increasing complexity, simplicity underlies the best investment strategy. So on this graph, I'm just looking at the S&P 500 price index. Now, this is not total return. It's not including the reinvestment of dividends. It's just the index level. And that's one thing that you need to understand, is that when you're looking at the S&P 500, the index is just a price level, okay? But if you're invested in the S&P 500, for example, through an exchange-traded fund, an index fund, you will be receiving some dividend distributions, okay? And you'd have a total return. Anyhow, so this is looking from 1997 up until, this is from September the 30th, 2018. And I'm getting this from the JP Morgan Guide to the Markets, US data. And if you Google search JP Morgan Guide to the Markets, you'll find this PDF that comes up. I find that's a really good document that I often use for various different purposes. But anyhow, you can see that at September 30th, 2018, the S&P 500 level was at 2914. January 4th, it's come down a little bit to 2531.94 at the close on January 4th, okay? Nevertheless, the reason why I'm showing this is that here you can see the volatility. Again, a picture is worth 1,000 words. The S&P 500, you can see the crash here in 2008. Now, the calendar year returns that we look at was like negative 32% or something like that. But if you're actually looking from the peak at October 9th, 2007, down to the trough on March 9th, 2009, the decline in the index level was 57%. And since then, we've had a strong multi-year bull market, okay? But you can see this is the volatility with regards to investing in stocks, or in particular in the S&P 500 in this case. So on this slide, I'm looking at a graph at the S&P 500 annual returns from 1970 to 2016, and this includes dividends, okay? And I've got this data from New York University, Damodaran's website, which I can just show you very soon. But what this is showing is the annual calendar total returns, including dividends. And again, a picture's worth 1,000 words. You can see the level of volatility here. You know, some years the markets is up as much as close to 40%. And if we look at, again, 2008 calendar year, it was a return of close to negative, between negative 30 and negative 40%. But if you went from peak to trough, as I showed you, it was actually negative 57%. So that's a lot of volatility, okay? So I did this chart back in 2016. I just showed you that 2017 was a positive year and 2018 was a negative year, approximately, total return including dividends, negative 7%. So I'm putting this slide in here. I've made a histogram from that data. And this is, again, just building up on that quantitative concepts that you studied. Now this is the application of it. So we looked at the S&P 500 annual returns, including dividends. And you could see that there's quite a bit of variability. So then the next thing that I do is I do a sort to the data. And then I create ranges of returns. You can see 0 to 10% positive, 10 to 20%. 20 to 30, 30 to 40. On the positive side, on the negative side, 0 to negative 10%, negative 10 to 20%, negative 20 to 30%, negative 30 to 40%. And then I do a count of how many years the calendar year returns fell into those ranges. And so you can see here the negative 30 to 40% just one time. That was 2008. Okay, so you can see that was 2008. And again, I did this chart in 2016, so I updated it. 2017 would be added to this bar, the 20 to 30% range, and the 2018 would be added to this bar, the 0 to negative 10% range. So again, following up on the quantitative concepts, that's how we create a histogram. We looked at the annual calendar year returns, we do a sort, and we create some ranges of returns, and then we count the frequency of how many years the return fell into that category, and that creates our histogram. And you can see what comes out of it is that in general, on average, there's more positive years than there are negative years, and that's why long-term on average, by investing in stocks, we're going to grow our capital, but we have to expect some negative years, and we have to accept the volatility. So what this graph is showing is 6 asset allocation profiles, okay? And this is actually something from RBC Dominion Securities in Canada, and it's showing 6 broad types of portfolios. The first one is secure. So you can see a secure portfolio, low risk, fairly low return in terms of its expectations. Income, and it's made up principally of fixed income and cash, and a much smaller proportion allocated to equities. Next category, second portfolio, is income. You can see what's happening here. You're allocating a little bit more to stocks, a little bit less to bonds. Okay, so you're increasing the risk and return profile. And as next portfolio is conservative, balanced growth, and aggressive growth. So you can see the aggressive growth portfolio has got the highest expected return and highest risk, and it's made up of mostly of equities, and the proportion to fixed income and cash is going down, okay? And that's the sort of the risk and return portfolio that most people are used to seeing. And indeed, when we look at that Ibbotson SBBI yearbook, you can see that long-term on average, the returns to stocks was quite good. But the thing that people have to understand, and part of the education process, is that in the shorter term, negative returns are reality. So if you're heavily invested in stocks, with higher risk and higher potential return, that in the short term you can have a very negative return. So again, that peak to trough for the S&P 500 was negative 57% on the price index, in 2008 to the bottom of 2009. So I just opened to a web page right now. You can see that Stern NYU, and this is Damodaran's website. Very excellent website that's got a lot of financial models, etc. But I like his annual returns on stocks, T-bonds, and T-bills from 1928 to current. So you can see here annual returns on investments in the S&P 500, 3-month T-bill, 10-year T-bond, and then he's doing the compounded value of $100, okay? And it says here the return on stocks includes both price appreciation and dividends. So how do you get the return? It's ending price plus dividends minus beginning price divided by beginning price. Okay, that gives you your total return. And so he's done the calculations from starting in 1928. It's not updated yet for 2018. It ends at 2017, and then he's doing the growth similar to what we saw with the Ibbotson SBBI yearbook, the growth of $1. He's showing the growth of $100. Okay, starting in 1928, and the same message comes through that if you look here. If you invested in stocks, the growth of $100 is giving you quite a substantial capital return versus the T-bills or the T-bonds. Okay, so again, this is the website of Aswath Damodaran. Very excellent website. So again, if you're interested in finance, just wanted to show you the front page, Damodaran Online. And you can see a little bit about him, teaching, writing. I got the data from here, and he's got certain tools. The tools incorporate spreadsheets that he's developed over time to value and analyze companies, and short in practice webcasts, etc. Anyhow, valuable reference site. As I mentioned, part of the studying process is going outside of the curriculum and finding different resources or websites to help complement your understanding. And I like this one because it gives me data on the S&P 500 total returns versus the T-bonds, and the T-bills and the bonds. Okay, this slide is just showing some quotes from Benjamin Graham on risk, and also some quotes from Jason Zweig, who does the commentary in the book, The Intelligent Investor by Benjamin Graham. Anyone that has an interest in investing in stocks should read The Intelligent Investor by Benjamin Graham. Okay, Benjamin Graham stated that every investor who owns common stocks must expect to see them fluctuate in value over the years. And that's the point of showing the graphs showing the historical returns. Okay, markets run through trends and cycles, and you have to understand that variability in annual returns. If you overestimate how well you really understand an investment or overstate your ability to ride out a temporary plunge in prices, it doesn't matter what you own or how the market does. So Jason Zweig, in his commentary on Chapter 20, says ultimately financial risk resides not in what kind of investments that you have, but in what kind of investor you are. So the market is a pendulum that swings between unsustainable optimism, which makes the stocks too expensive, and unjustified pessimism, which makes them too cheap. The intelligent investor is a realist who sells to optimists and buys from pessimists. So Warren Buffett sort of echoed this advice when he said, "Be fearful when others are greedy, and greedy when others are fearful." He said that in 2008 in his annual letter. And he also said that the sillier the market's behavior, the greater the opportunity for the business-like investor. So success comes from harnessing our emotions and understanding the things we can control and cannot control. So this next slide is just showing a graph from a white paper from Barclays. If you Google search Barclays average investor emotions, you'll find that a white paper comes up and it has this graph. So what they're showing is average investor emotions can affect investment returns, and that's what I'm following up on, those quotes by Benjamin Graham and Jason Zweig, is that saying for the average investors, markets are rising, very strong bull markets, then the average investor is buying, and they're going through different types of emotions, excitement, exuberance. But as the markets start to correct, and as we saw that negative 57% plunge in prices in 2008 from peak to trough, the average investor can experience depression, panic, capitulation, and sell. And so they're doing the exact opposite. We're supposed to buy low and sell high, but the average investor's emotions can influence people to buy high and sell low. Okay, and that's why it's important to understand trends and cycles and returns long-term returns for different asset classes, and understanding not only the returns but also the risks. So finally, down to the end of my mini lesson on equities before we jump into the requirements for the Foundations program, I just wanted to give some overview on the global framework of indexes. Okay, so MSCI provides indexes, And so we can see here, if we're starting at the top, there's the MSCI All Country World Index and Frontier Markets Index, and this is basically covering all the markets throughout the world. But if we stick here to the left-hand side, we can see the MSCI All Country World Index, and that's made up of the MSCI World Index, which is developed markets, which is something that's important to understand, and the MSCI Emerging Markets Index, which probably a lot of people that have studied a little bit of finance have probably heard about it, and that includes the emerging markets. So MSCI All Country World Index is made up of the MSCI World Index plus the emerging markets. And the World Index is made up of developed markets in the Americas, such as Canada, the United States, Europe and the Middle East, and the Pacific, okay? So if you're looking at emerging markets in Asia, Thailand is an emerging market, Taiwan is an emerging market, Korea, Malaysia, etc. You can see that Saudi Arabia is being upgraded by MSCI to a emerging market index, but again, there's a standalone. And if we look here at the frontier markets, we can see that in the Middle East, certain countries like Kuwait and Bahrain, Jordan, Lebanon, Oman, these are all considered to be frontier markets, okay? In terms of Asia, Vietnam is a frontier market. The stock market there just started in the 1990s. And so anyhow, the main key thing to understand is that globally, there's a global framework for markets. And we talk about markets either being frontier, emerging, or developed, okay? And that's fairly important to understand because, you know, depending on where you live in the world, you may not be investing only in your home country if it's a frontier market, but also be looking globally to invest. And in that case, you're probably looking at something like the MSCI World Index or the MSCI Emerging Markets, okay? So just showing you some more data on this. You know, I've got some data that's from the iShares. This is an ETF, a product, exchange-traded fund that's meant to replicate the MSCI All Country World Index. I could get this data from probably the fact sheet at MSCI. If you Google search, they'll have fact sheets for their other indexes. But often I look at an exchange-traded fund that's meant to replicate an index, and sometimes I can get more current and up-to-date information. So again, just to remind you, the MSCI All Country World Index, so there is an investable product, and that's made up of the World Index plus emerging markets. And if we drill down to look at the geography, we can see that the United States is so heavily weighted, and that shows you that's weighting in terms of market capitalization, which is the number of shares outstanding times the market price. So from this, we can see that clearly the United States, in terms of market capitalization, is the biggest market by far, okay? So it's followed by Japan, United Kingdom, China, France, and here we are in Canada. And Canada hasn't changed for years and years. We're always making up about 3% of this index in terms of market capitalization. And then often, so we want to look at not only the geography, but also in terms of the sectors. What sector is most heavily represented in the index? Well, it's the financial companies, okay, followed by IT. However, if we look at the top three companies globally by market capitalization, number one is Microsoft, number two is Apple. For a time there, Apple was the number one company, but the stock price has come down a little bit. And number three is Amazon, okay? And I got that data just from the iShares website with, Google search iShares MSCI All Country World Index, and that gave me a little bit of information with regards to the geography and the sectors. And that's the last slide for my overview in terms of equities that I like to give before we jump into the chapter at the foundations level, looking at specific features about stocks, etc. I think it's important that you have a kind of a bigger picture before we jump into the chapter on stocks, equities. So now we're back to the CFA Institute Investment Foundations program. The first learning outcome statement A is describe features of equity securities. So some of the features we're going to look at, you can see there's 4 on this slide. Number 1 is life. Many equity securities are issued with an infinite life. That means there's no maturity date, but some can have a maturity date, okay? Par value. The par value of the share is the stated value or face value of the equity security, Equity securities may or may not be issued with a par value, so that's something to understand. In terms of voting rights, some shares give their holders the right to vote on certain matters. Shareholders with voting rights collectively elect a group of people called the board of directors. And another feature of equity securities is cash flow rights. Cash flow rights are the rights of shareholders to distributions such as dividends made by the company. In the event of the company being liquidated, assets are distributed following a priority of claims or seniority ranking. We saw that a little bit in the chapter on debt securities with regards to the seniority ranking on different types of bonds. Okay, remember there was secured and unsecured, and then within the unsecured there was the three different levels of ranking. Learning outcome statement B is describe types of equity securities. So on this slide you can see types and classes of equity securities. There's 5 that are listed here, starting with common shares, also called common stock, ordinary shares or voting shares. So again, if English isn't your first language, this is one of the challenges that I have with students. I've taught CFA globally, and sometimes it's the language. Again, it's English language test subject equities. So common shares, common stock, ordinary shares, voting shares, all meaning the same thing. Another type of equity security is preferred shares, also known as preferred stocks or preference shares. And convertible bonds can be converted into shares of common stock. In this chapter, we're also going to look at warrants, which are an equity-like security that entitles the holder to buy a specified amount of common stock of the issuing company at a specified price per share. And a warrant is an example of a security that does not have an infinite life. It would have a maturity date on it. And finally, we will look at depository receipts, which is a security representing an interest in a foreign company that trades like a common share on a domestic stock exchange. So those are the 5 broad types and classes of equity securities that we'll be looking at in this chapter. So first, we're going to look at classes of common stock. Common stock, again, also known as common shares, ordinary shares, or voting shares, is the main type of equity security issued by companies. Okay, so common stocks represent an ownership interest in the company. Assets equals liabilities plus equity. Equity is ownership. Okay, it has an infinite life and may or may not have a par value. So there's important thing here to understand with regards to classes of shares. When there's one class of share, one class for voting rights, cash flow, and dividends right, it means one share, one vote, okay? But you have to understand that some companies can issue multiple classes of shares. There might be a Class A share that has superior voting and or cash flow rights, and a Class B share that it will have a lower voting right and or dividend rights. So now we're moving on to preferred stock, and companies may also issue preferred stock, also known as preferred shares or preference shares, and they are called preferred because owners of preferred stock will receive dividends before common shareholders and will have a higher claim on the company's assets if the company ceases operations. So remember from the chapter on financial statements or accounting, we had our net income. Out of that net income, we're going to pay dividends, okay? Dividends are paid to preferred shareholders first, and then we have the earnings available to common shareholders. And then dividends may or may not be paid to the common shareholders, okay? So they're called preferred shares because they receive the dividends before the common shareholders, okay? So preferred stock is typically issued with an assigned par value. In the U.S. and Canada, that would be, say, $100, along with a stated fixed dividend rate. It's a fixed dividend rate. So if it's a 5% dividend on a $100 par value, you'd have a $5 dividend, okay? And that defines the amount of the annual dividend. So again, assigned par value, like $100, and a stated fixed dividend rate, okay? Cumulative preferred stock requires that the company pay in full any missed dividends, dividends promised but not paid, before paying dividends to common shareholders. So let's say a company has a year where they have serious cash flow problems, negative net income, and they do not pay, they don't pay preferred dividends or common dividends. If it's a cumulative preferred stock, it means in the next year, if they've had a good year and they've got positive cash flows, they can't pay any dividends to the common shareholders until they've paid back to the preferred stockholders all the dividends that are owing to them. So it's cumulative preferred. In contrast to that, a non-cumulative preferred stock does not require that missed dividends be paid before dividends are paid to common shareholders. So that's very important. That can be tested. Cumulative preferred stock means those dividends that aren't paid need to be paid in full. You need to pay any missed dividends before paying any common dividends to common shareholders. And non-cumulative, well, if that dividend's been missed, too bad, so sad. It does not require that missed dividends be paid before dividends are paid to the common shareholders, okay? So a very important thing to understand is that some companies have more than a single issue of preferred stock, and we call that a series. Each issue usually carries its own dividend. So a quick practice question to check our understanding from the learning ecosystem, and this was classified at the expert level. A firm's preferred stock may differ in par value based on the preferred stock A series, B rating, or C dividend. So the correct answer is series. A is correct. A firm's preferred stock may differ in par value based on the series of the preferred stock. Okay, just want to bring the real world into the classroom a little bit. Here I am at the RBC website, and I'm looking at some share information. So Royal Bank of Canada, they've got common shares, which the ticker symbol is RY on the Toronto Stock Exchange, and that's the largest company in Canada in terms of market capitalization. And it's also listed on the New York Stock Exchange. So here you could have some dividend history. Later on we're going to look at the concept of stock splits. There's the stock chart, etc. So, some of the things that we're going to be talking about in terms of equities, it's nice to go out and look at a company's website, and dig a little bit deeper. But because we're talking about preferred shares, if I scroll here, you can see that Royal Bank of Canada has issued preferred shares, and they trade on the Toronto Stock Exchange. So here's all the different series, and there's the ticker symbols, and you can see there's a number of different prospectuses, okay? So if I just click on one, randomly, ry.pr.d, so this is series AD, and I click on the perspective, let's see what we find. Okay, so I'm opening this perspective, and you can see this prospectus. It was dated September the 1st, 2005, and you can see here that the Royal Bank of Canada raised $250 million by issuing 10 million non-cumulative first preferred shares Series AD. So this was a non-cumulative preferred share, okay? And you can see here that the price is $25 per Series AD to yield 4.5%. So if I just bring up my calculator here, you can see 10 million preferred shares were issued times a par price of $25. So they're raising $250 million, okay? And so again, it says here to yield 4.5%. So if I look at the $25 and I multiply it by 0.045, you can see that the annual dividend would be $1.125, okay? And you can see that the dividends here are going to be paid quarterly, so it's a quarterly dividend on the 24th day of February, May, August, and November in each year commencing on May 24th, 2007, okay? So again, if I just bring up the calculator there, $25 times 4.5% gives us $1.125. I divide by 4 for the quarterly, and you can see, so each dividend would be 0.28125, and there it is at a quarterly rate of 0.28125 per share, okay? So again, you can see the price to the public, $25. There's an underwriter's fee, 75 cents. So the underwriter was going to make a healthy $7.5 million for selling, helping to sell this series, and the net proceeds to the bank would be $24.25. Okay, and they're going to trade then on the Toronto Stock Exchange. Again, we can have a quick look at that. Okay, so if we try to find a the current market price for ry.pr.d, in fact, we find that in November the 24th, 2018, that preferred share was redeemed. Okay, so it was bought back by Royal Bank. The preferred shareholders received the price of $25 per share, and it was paid on November 26, 2018. Okay, so that you have to understand that the Royal Bank, that Series D, was a redeemable preferred shares, which means that the company had the power to buy back that preferred share from the shareholders. Okay, so it doesn't trade anymore. So again, if we go back to the prospectus, we can see here that in this paragraph, subject to the provision of the Bank Act in Canada and the consent of the Superintendent of Financial Institutions, on or after February 24, 2012, you can see that these were being issued in 2006. On or after February 24, 2012, the Royal Bank may redeem the Series 80 preferred shares in whole or in part by the payment of a cash sum equal to $25 per share. And that's indeed what happened in 2018. These were non-cumulative preferred shares that were redeemable, so they did not have an infinite life. So again, just continue with bringing the real world into the classroom. You can see that in Canada, the main stock exchange in Toronto, the index is the S&P TSX, but then there's also a number of sub-indexes. So we could look here at the S&P TSX Preferred Share Index. Okay, so this is an index measuring preferred shares that are listed on the stock exchange. And so if we went to the 5-year return, it's giving you some charting data. But what we want to look at is perhaps the sector in top 10. You can see that financials heavily dominate. So banks issue preferred shares, and then it's followed by energy companies in Canada. Okay, so the financials, in terms of the preferred share index, financial companies are making up 64%. Okay, so you can see here some of the different preferred shares in terms of the top 10. TD Bank, so it would be TD preferred Series H is still trading, and then TransCanada is an energy company, and then we get into some Royal Bank of Canada preferred series. Okay, so you can see ry.pr.r, that's Series BM, ry.pr.q is a Series BK, and then we get to an Enbridge preferred share, which is again a pipeline energy company, followed by some other another TD series preferred. Okay, so that's just showing you that preferred shares are issued. They can be cumulative, non-cumulative. They can be redeemed in some cases, as we looked at that TD Bank account, TD Bank preferred series, and that there is in fact preferred share indexes, which is a sub-index of the S&P TSX. Okay. So just going back to the Royal Bank of Canada website, so you can see the series that is still trading is this ry.pr.r. Again, if I click on the prospectus, you can see that this was in 2016. The Royal Bank of Canada raised $750 million through $30 million non-cumulative 5-year rate reset preferred shares series. Okay, so that's showing a non-cumulative 5-year rate reset preferred share was issued, and so that's got some different types of features, and you can see again the price was $25, and it was initially to yield 5.5%, and it was going to be traded on the Toronto Stock Exchange. And it also says here that let's just look at what that feature is in terms of the 5-year rate reset. Okay, so we can see initially that the it was to yield initially 5.5%, but then you can see here that it says again it's a quarterly dividend, 24th day of February, May, August, and November in each year, as and when declared by the board of directors. Okay, so these are non-cumulative again, so if it's not paid, next time they pay a dividend, they don't have to make up these lost dividends. If they were not paid, they have to be declared by the board of directors. But what it's saying here, it says we will determine the annual fixed dividend rate for each ensuing subsequent fixed rate period on the fixed rate calculation date, and that rate will be equal to the sum of the Government of Canada yield So that was something that we looked at in terms of fixed income securities, sovereign bonds, and the yield curve. So again, this is an application of it. So you can see with regards to this Royal Bank of Canada, preferred share that has a rate reset. It's based on the Government of Canada yield on the calculation date plus 4.8%. Okay, so that is going to be a floating rate preferred share. So that's a feature, again, a little bit of a feature with regards to preferred shares. So here I am in the learning ecosystem. I've got the lesson open, and you can see that indeed the example for preferred stock that they're using was a Royal Bank of Canada Series B. Okay, so I know I spent a little bit of time there, but just wanted to show you that with a bit of Google searching and a bit of effort, you can dig out this information, and that's doing kind of the extras to help you complement the curriculum. So then, as we move on from the preferred shares, you can see that we move into a section here on convertible bonds, even though we're in a section on equities. Okay, and the reason is that convertible bonds is a bond issued by a company that offers the bondholder the right to convert the bond into a pre-specified number of common shares. Okay, so although a convertible bond is actually a debt security prior to conversion, the fact that it can be converted to common shares makes its value somewhat dependent on the price of the common shares. Thus, convertible bonds are known as hybrid securities. Hybrid securities have features of and relationships with both equity and debt securities. Okay, so we're going to go through, as you scroll down, you're going to see here an example of a convertible bond, and we get into some of the terminology that we need to be familiar with. Okay, so the number of common shares that the bondholder will receive from converting the bond is known as the conversion ratio. The conversion ratio may be constant for the security's life, or it may change over time. The conversion value or parity value of a convertible bond is the value of the bond if it is converted to common shares. And again, you're going to understand these terms better when you work your way through an example. Is what we're going to do next. Okay, so the conversion value is equal to the conversion ratio times the share price. And this is the important thing to understand, is that conversion, the bonds are retired, they cease to exist, and common shares are issued. Okay, and it's important to understand that the conversion feature is a benefit to the bondholder, and because the conversion feature is a benefit, then a convertible bond typically offers the bondholder a lower fixed annual coupon rate than that of a comparable bond without a conversion feature, which we call a straight bond. Okay, and so of course convertible bonds have a maturity date. If the bonds are not converted to common stock prior to maturity, they'll be paid off like any other bond. We saw that in the previous chapter on fixed income securities, and the bond will be retired at the maturity date. When a convertible bond is issued, the conversion ratio is set so that its value as a straight bond, i.e. the value of the bond if it were not convertible, is higher than its conversion value. If the share price of the company significantly increases, the conversion value of the bond will rise and may become greater than the value of the convertible bond as a straight bond. If this happens, then converting the bond becomes attractive. In general, if the conversion value is low relative to the straight bond value, the convertible bond will trade at a price close to its straight bond value. But if the conversion value is greater than the straight bond value, the convertible bond will trade at a value closer to its conversion value. Okay, so anyhow, we'll jump through and look at this example number 3 on the Navistar, which is a U.S. company, and they issued some convertible bonds in 2009. So what I've done on this slide is I've combined the example of the convertible bond with some of those terms that we looked at to make it a little bit easier to understand for you. Okay, so starting with the conversion ratio is the number of common shares that each bond can be converted into. The indenture, which is the bond contract that we learned from the previous chapter, sometimes does not stipulate the conversion ratio, but only mentions the conversion price. Okay, but in this case, when we look at this Navistar, this convertible bond, I've highlighted, it says owners of the convertible bond issue may convert each $1,000 bond into 19.891 common shares. So that's the conversion ratio, each $1,000 bond into 19.891 shares. The conversion value, sometimes called the parity value, is the current share price multiplied by the conversion ratio, okay? So you can see it says that on 9th of October 2012, the company's common shares closed at $22.26. Therefore, each $1,000 bond's conversion value was $442.77. That's the $22.26 times the 19.891 shares, okay? The conversion premium is the difference between the convertible bond's price and its conversion value. So, for example, if the convertible bond's price is $912, and that's the market price on the bond on 9th of October 2012, and the conversion value is $442.77, then the conversion premium is $912 minus, I've rounded it to $443, equals $469. Then finally, what we're looking at here is the conversion parity occurs if the conversion value is equal to the convertible bond's price. So we can see here, if the bond price was $912, the stock price would have to be $45.85 for parity. That would be $45.85 stock price times the 19.891 shares that you would receive for each $1,000 bond. That would equal $912. That's when you would get the conversion parity, okay? So a little bit of terminology that you need to be familiar here with regards to convertible bonds. Some of that can be tested in terms of, not having to make many calculations, but just understanding what the conversion ratio is, the conversion value, the conversion premium, and conversion parity, okay? And I find it helps by putting the terms here and looking at a concrete example. So a quick practice question from the learning ecosystem that was classified as expert level. When a convertible bond is issued, compared with its conversion value, its value as a straight bond is most likely A, higher, B, lower, or C, the same. Okay, so that's a little bit of a tough one. A is correct. The conversion value of a convertible bond is the value of the number of common shares into which it is convertible. When first issued, the conversion value is below the value of a straight bond to deter investors from immediately converting bonds to common shares and making an instant profit. Okay, so a little bit of a graph here. If you Google search, looking at a convertible bond price versus a stock price and what's happening with regards to the conversion parity, the key thing to understand is that when the stock price is low, the convertible bond trades much like a bond, but as that stock price starts to increase, then the convertible bond price is going to increase because it's becoming more valuable to convert it into common shares, okay? So now we're moving on to warrants, and a warrant is an equity-like security that entitles the holder to buy a pre-specified amount of common stock of the issuing company at a pre-specified stock price called the exercise price or strike price prior to a pre-specified expiration date. So this is like an option, okay? A warrant is an option to buy shares. So options give you the right but not the obligation to buy the stock at a pre-specified price called the exercise price or stock price, and it's prior to a pre-specified expiration date. So you can see that warrants are not securities with an infinite life. There's going to be an expiration date. Now, a company may issue warrants to investors to raise capital or to employees as a form of compensation. So you can see there's two goals there. That's important to understand. The holder of warrants may choose to exercise the rights prior to the expiration date and will exercise the right only when the exercise price is equal to or lower than the price of the common shares. Of course, I might have the right to buy at $10. I'm not going to do that if the stock price is at $8. I'm going to do it if the stock price is at $12. That's my right, but not the obligation to exercise, and I'm going to exercise when the stock price is equal to or lower than the price of the common shares. When a warrant holder exercises the right, the company issues the pre-specified number of new shares and sells them to the warrant holder at the exercise price. Again, warrants typically have expiration dates several years into the future. In some cases, companies may attach warrants to a bond issue or a preferred stock issue known as sweeteners. Again, raising capital is supply and demand. If companies want to raise capital, sometimes they need to offer some sweeteners, and attaching a warrant to a bond issue or preferred stock issue is a sweetener. It gives you the right, but not the obligation to convert into common shares, and if the common shares do very well, that's a fairly attractive sweetener. Companies may also issue warrants to employees as a form of compensation, in which case they are referred to as employee stock options. When warrants are used as employee compensation, the goal is to align the objectives of the employees with those of the shareholders, so everyone's rowing in the same direction. Many companies compensate their senior management with salaries and some form of equity-based compensation, which may include employee stock options. So a quick practice question from the learning ecosystem, and this one was classified as expert. And again, I'm putting this in here because I want to show you that it's very much an English language test subject, stocks in this case. And we're learning, that's why it's the importance of the glossary, and understanding all the terminologies in the language. And if you do that and pay some attention to it, you'll find that the question is not all that difficult, in fact. Anyhow, the question is the pre-specified price for which a warrant can be used to purchase common stock is the A, strike price, B, buyback price, or C, conversion price. And the correct answer is A. The pre-specified price for which a warrant can be used to purchase common stock is the strike price or exercise price. Now we're moving on to depository receipts, known as global depository receipts, or GDRs, and if they're trading on the American US and on a U.S. stock exchange, we call them ADRs, American Depository Receipts. Okay, so a depository receipt is a security representing an economic interest in a foreign company. GDRs trade like a common stock on a local stock exchange. For investors buying shares of foreign companies, the transaction costs associated with purchasing depository receipts are significantly lower than the cost of directly purchasing the stock on a foreign country stock exchange. Okay? Depository receipts are not issued by the company and do not raise capital for the company, but rather they are issued by financial institutions. So that's very important to understand, that depository receipts not issued by the company do not raise capital. They're issued by financial institutions. So they run through an example here. For example, Mexican investors may wish to invest in the stock of Sony, which is a Japanese company. But Sony stock is not listed on the Mexican stock exchange. Buying Sony stock on the Tokyo Stock Exchange is expensive and rather inconvenient. To make this process easier, a financial institution in Mexico, such as a bank, can buy Sony stock on the Tokyo Stock Exchange and make it available to local Mexican investors. Rather than making the shares directly available for trading on the Mexican Stock Exchange, the bank holds the shares in custody and issues global depository receipts against the shares held. The GDRs issued by the custodian bank are listed on the Mexican Stock Exchange for trading. In essence, the Sony GDRs trade like a stock of a domestic company on the Mexican Stock Exchange in the local currency, the Mexican peso. GDRs, like the shares they are based on, have no maturity date. They have an infinite life, so that's important to understand. Not like warrants that have an expiry date or convertible bonds that have a maturity date. GDRs have no maturity date. They have an infinite life. And GDRs typically do not offer the owners any voting rights, even though they essentially represent common stock ownership. The custodian financial institution typically retains the voting rights associated with the stock. And that's a point that gets heavily tested, not only likely for the CFA foundations, but also at the CFA program, because this GDRs and ADRs are also covered in the CFA program. And it always comes up about these voting rights, because common stockholders have voting rights, but GDRs do not offer their owners any voting rights. The custodian financial institution retains that right. Okay, so pay attention to that. In the United States, GDRs are known as American Depository receipts, ADRs, as I mentioned. Okay, if any of you have looked at my LinkedIn profile, you see that I was a finance director for SAP in Asia for 5 years. I started with SAP in Canada. SAP is a German software company, and its stock is listed in Germany. However, there is an SAP ADR, American Depository Receipt, that trades in the U.S. So this gives U.S. investors the chance to essentially participate in SAP common shares, but again, you don't receive any voting rights. So if I look at a 10-year chart here, you can see that 10 years ago, the price was at $37.62, and the current price is up around $99.71. So very much like a common share chart, but it's an American Depository Receipt, which means the common shares of SAP have been bought by a financial institution, and the depository receipts are then sold and traded on the U.S. stock exchange. So now we're moving on to Learning Outcome Statement C, which is compare risk and return of equity and debt securities. So we're looking at cash flow and voting rights. So we're looking at 3 types of securities on this slide: common stock, preferred stock, and debt securities. In terms of cash flow rights, common stock shareholders have the right to dividends if declared by the board of directors. So they're not guaranteed. Dividends have to be declared and approved by the board of directors. In terms of voting right, common stock gives voting rights proportional to the ownership, unless there's 2 class series, Class A, Class B, in terms of common stock, which we saw. And the reason why a company may want to offer different series of common stock with different voting rights is if the original owner wants to regain control of the wants to maintain control of the company, but wants people to participate perhaps in the appreciation of the stock price and dividends. Okay, so there's a lot of debate and discussion about dual class shares. Anyhow, in terms of liquidation, if a company goes bankrupt, common stockholders have the lowest priority. Assets equals liabilities plus equity. Sell all the assets, pay all the liabilities, which are debts. What's left over is equity, and that's why we say equities have a residual value. Okay. Now, if we move on to preferred stock, in terms of cash flow rights, preferred stock gives the right to promise dividends if declared by the board of directors. Board does not have a legal obligation to declare the dividends. And then recall, there's 2 different types of preferred stock in general, cumulative and non-cumulative. Cumulative means that if the board of directors did not pay a dividend in any given year, then the next time they go to pay a dividend, no dividends can be paid to the common shareholders until those cumulative dividends have been paid back to the preferred stock. Now, if it's a non-cumulative dividend, if the board of directors does not declare the dividend and doesn't pay it, then the next time they go to pay a dividend with a non-cumulative, they have no legal obligation to pay back a missed dividend. What the important thing to understand, preferred stock has no voting rights, and in terms of liquidation, it's a middle priority. Falls in between debt and common shares. And again, if we look at the debt securities, we covered that in the previous chapter. That's a legal right to a promised cash flow, and there can be different levels of seniority: secured debt, unsecured debt. And of course, debt security has no voting rights. And in terms of a liquidation, assets equals liabilities plus equity. Sell all the assets, pay all the debts. Debts have the highest priority. So here I am very quickly in the learning ecosystem in the lesson. And you can see Exhibit 2 here in this chapter, priority claims. We're starting with the secured debt, then we get the unsecured debt. Unsecured debt has got 3 levels: the senior unsecured debt, senior subordinated debt, and then the junior subordinated debt. And you recall, we saw that in the previous chapter on fixed income securities. So what we've added to this priority of claims now, you can see that below the debt, we've got the equity securities, and preferred stock has a priority over common stock. So this is the priority of claims that you need to be familiar with. The highest claim is secured debt. Second is unsecured debt, split between senior unsecured, senior subordinated, junior subordinated. And then finally, equity securities are residual, but within equity, preferred stock has a priority over common stock. So again, continuing with the risk and return of debt and equity securities, you can see common stock has the highest risk, highest expected return, and we saw that in my preview to the chapter through the Ibbotson data. Preferred stock has middle risk, middle expected return, and debt securities have the lowest risk and the lowest expected return. How did we measure risk? It was through variability in cash flows, which is, variability is in price, and that is measured through variance and standard deviation. So I'm just in the CFA program text for level 1. I just wanted to show you that there's a lot of overlap between what you're learning at the Foundations program and if you move up then to the CFA program. Okay, so you can see here Exhibit 5 from the chapter on equities, returns and risk of major asset classes since 1900. So it's a similar thing. It's just showing equities here. And so the real return is 5.4%. And again, you learn that in economics. What is real return? It's basically the nominal return minus inflation rate, okay? And again, we'd have to look at what they're using for that equities benchmark or classification, okay? Bonds have a real return of 1.7% and T-bills 0.9%. Again, that Ibbotson data was showing nominal returns. Remember, inflation was at about 3% since 1926. You can see here the nominal returns 8.5, 4.8, 3.9. Again, we'd have to look at their source of data. And then, of course, in terms of standard deviation, which is the square root of variance, you can see that the equities had the highest nominal and real returns, and they had the highest standard deviation or risk, followed by bonds and T-bills. So again, by now you should have a fairly strong understanding that equities as an asset class provide. Okay, here's a practice question from the learning ecosystem classified at the expert level, and it's a tricky one. It's one of these where it's not exactly in the text, but it's the type of question when they get to the expert level, you're expected to sort of apply your knowledge, so you have to think about it a little bit. Anyhow, here's the question. The type of investor who is most likely to have the greatest incentive to closely monitor a firm's activities in regard to maintaining assets when the firm is struggling is A, debt holder, B, common shareholder, or C, preferred shareholder. Okay, the correct answer is A. A is correct. When a firm is struggling, a debt holder has the greatest incentive to closely monitor the firm's activities in regard to asset quality because shareholders have little incentive to maintain the assets in this situation. So again, assets equals liabilities plus equity. Assets minus liabilities equals equity. Equity is a residual value. Sell all the assets and you have to pay all the debts. Therefore, the debt holder is first in line. If you're first in line for the assets, you're most likely going to have the greatest incentive to closely monitor a firm's activities in regard to maintaining those assets, okay? So actually expert question, but not that too tough to understand the logic. Assets minus liabilities equals equity. Sell all the assets, pay all the debts. Debt holders are first in line. They've got the greatest incentive to monitor firm's activities with regards to maintaining the assets. Okay, again, learning outcome statement C is comparing risk and return of equity and debt securities. So I showed some Ibbotson data and I showed some data from Damodaran. This is just the table that's in the text, and it's showing historical annual returns on equity and debt securities, 1980 in this case to 2010. So again, different time periods. And in terms of the equity, they have different indexes here, the S&P 500, the Russell 2000, MSCI Europe, the FTSE All World. Again, if you want more information about the indexes and what their constituents are, then just Google search it. And then for the debt, they've got a couple of different bond indexes, which is important to understand. There's a Lehman Brothers Corporate Bond Index. There's a Barclays Capital Corporate Government Bond Index. And finally, they're showing a Merrill Lynch World Government Bond Index. There's thousands of different equity and debt indexes. This is just a selection, and they're showing the annual returns and again the standard deviation of returns. So by now you should be sort of familiar with this type of chart that's showing not only the return but also the standard deviations of return, and that's how we measure risk through variability. Okay, this is my own slide, and what I've done is I took the table from the text, I put it into Excel, and then I did a sort on annual return from highest return to the lowest, okay? You can see the annual returns is now sorted. And so what you should expect to see at the higher annual return is a higher level of risk as measured by standard deviation of returns. So the MSCI Europe from 1980 to 2010 had a slightly better return than the S&P 500, but its risk was a little bit higher, okay? So what I did in this fourth column, or third column with the numbers, is I took that return column and I divided it by the risk column. Because one of the things when we study portfolio management, one of the things we learn is the Sharpe ratio, okay? And the Sharpe ratio is defined as the return of a portfolio minus a risk-free rate divided by the standard deviation of the portfolio. That gives us a Sharpe ratio, and it's a it's a return to risk measurement. And the higher the Sharpe ratio, the more efficient is the portfolio. Okay, so you can see here that the bonds have a good return to risk ratio, mostly because the standard deviation returns is lower, and we learned that bonds have a lower risk, lower standard deviation returns. So relative to the returns, they're fairly efficient. And that's one of the reasons why bonds are attractive to add to a portfolio, is the lower standard deviation of returns, and also the correlation, negative correlation to stocks in general, okay, which we've looked at in a previous slide. So you can see here, I highlighted in green, that the S&P 500, when we're looking back at the stocks, pretty good return to risk ratio, 0.6923, okay? And here I've put some in red, where if you look at for 1980 to 2010, for example, the MSCI Europe, Asia, and Far East, annual compounded annual average returns 7.09%, with standard deviation returns 17.71, giving us a return to risk ratio of 0.4003. Not great if you compare it to, for example, to the S&P 500. So now we're moving on to Learning Outcome Statement D, which is describe approaches to valuing common shares. So valuing common shares is a complex process because of their infinite life and the difficulty of estimating future company performance. There are three basic approaches to valuing common shares. 1, discounted cash flow valuation. 2, relative valuation. And 3, asset-based valuation. Analysts frequently use more than one approach to arrive at an estimate of value for a common share. So they might use 3 different methods, and then they'll give a weighting to each of the methods, and then come up with a weighted average to come up with a an estimate for a stock price. And then again, they'll even put that within certain ranges based on adjusting some of their assumptions on their inputs. Okay. Anyhow, the discounted cash flow valuation approach takes into account the time value of money, and that's why we studied present value in the quantitative concepts. And then we saw in the chapter on debt securities that the price of a bond is simply the sum of the present value of all the future cash flows, which was the coupon payments and the par value maturity value being paid back when the bond matures. Okay, so very similarly, the discounted cash flow valuation for stocks estimates the value of a stock as the present value of all future cash flows that the investor expects to receive from the stock. So common shareholders expect to receive 2 types of cash flows from investing in equity securities: the dividends and the proceeds from selling the shares. So when we looked at the bond, the present value was the coupon payments and the maturity value of the bond, say $1,000 par value. When we're looking at stocks, when we use the discounted cash flow valuation method, we're looking at the present value of the future dividends, and then the present value of the selling the stock at some time in the future. We call that the terminal value. Okay, so this approach, this valuation approach applied to common shares relies on an analysis of the characteristics of the company issuing the shares, such as the company's ability to generate earnings, because dividends are paid out of earnings, the expected growth rate of earnings, and the level of risk associated with the company's line of business. Okay. The relative valuation approach estimates the value of a common share by using multiples based on prices such as earnings per share. We saw that the earnings per share ratio when we looked at the chapter on financial statements, the accounting chapter, basically. Remember, it's the price per share divided by the earnings per share, the PE ratio, okay? The key assumption of the relative valuation approach is that common shares of companies with similar risk and return characteristics should have similar values. So we can look at the PE value for a share, for example. Relative valuation relies on the use of price multiples of comparable publicly traded companies or an industry average. One multiple commonly used in relative valuation is the price to earning, as I said, which is the ratio of the stock price to its earnings per share. So just very quickly, again, looking at the JP Morgan Guide to the Markets as at September 30th, 2018, you can see that here's a chart of the S&P 500 index looking at the forward PE ratio. Now, we won't get into, with the forward more detail about that. Anyhow, it's a PE ratio, okay? And you can see that the 25-year average is 16.1 times. So the price, of the index is 16.1 times the earnings of the index, okay? And it's the same concept for a stock. And it's currently at 16.8. You can see here back at the 2000, it's up over 24 times, and so that's what we look at. Regardless if we're looking at the S&P 500 or we're looking at an individual stock, sometimes we look at the historical average because there's something called reversion to mean, and also we're looking is it over if there's a very high PE value relative to a 25-year average, we could say over here that the index is very perhaps overvalued. And here, back in after the crash in 2008, you can see that's the 2009 when the S&P 500 was down 57% peak to trough. You could see that the PE ratio was even below 10 times. Therefore, you could expect, based on historical averages and a reversion to the mean, that the market would come back up, okay? And so really looking, the stock market has had a strong run up, as we saw, since the trough at 2009. But if we look at the current PEs, it doesn't look particularly overvalued based on this chart. Okay, finally, this slide is looking at the third valuation approach. We looked at the discounted cash flow approach. We looked at the relative valuation. Now we're looking at the asset-based valuation. And the asset-based valuation approach estimates the value of the common equity by calculating the difference between a company's total assets and its outstanding liabilities. In other words, the asset-based valuation estimates the value of the common equity by calculating a company's net asset value. Assets minus liabilities equals equity. But the values of some assets on the balance sheet, as we learned in the chapter on financial statements, are based on historical cost, and the actual market value of these assets may be very different. So, for example, the value of land on a company's balance sheet is typically carried at historical cost and is never depreciated. It may be quite different from its current market value. So as a result, estimating the value of the equity of a company by using asset values directly from the balance sheet may provide an invalid value estimate. To improve the accuracy of the value estimate, estimates of current market values may be used in place of historical asset values reported on the balance sheet. But you could imagine that would be very hard to do. Also, some assets may not be included on the balance sheet because of financial reporting rules. That's called off-balance sheet stuff, but we won't get into it at this point. So, for instance, and also there's some internally developed intangible assets such as brand or reputation are not listed in the financial reports. Anyhow, the asset-based valuation approach implicitly assumes that the company is liquidated. So you're looking to use this valuation approach in a situation where a company is going bankrupt and it's being liquidated, so you're going to sell the assets and pay all the debts. So sell all the assets, pay off all the liabilities. What is left over is the residual value, and that's the value to the shareholders. So this is an important slide, and it's just showing some of the implicit assumptions of valuation approaches. So first, starting with the discounted cash flow valuation approach, it relies solely on estimates of a company's future cash flows and implicitly assumes that the company will continue to operate forever. And so you can see, to estimate future cash flows, you need to estimate future earnings. It's quite complicated. The relative valuation approach is a lot easier because you're not estimating future cash flows, but instead using a price multiple of other comparable publicly traded companies to arrive at an estimate of equity value. Okay. The asset-based valuation approach implicitly assumes that the company will stop operating and essentially provides a liquidation value. So you don't use the asset-based valuation approach to look at the intrinsic value of a stock, what you think the value should be today. The asset-based valuation approach assumes that the company will stop operating and provide a liquidation value. That's much different than the cash flow discounted cash flow valuation approach that assumes the company will continue to operate forever. So that's the type of things that they could ask and test you on. So this is the example from the text for the discounted cash flow. And again, on the test, you're not really required to do the calculations. You don't need your calculator, but I will walk you through it just so you understand it. And so anyhow, in this example, you forecast that a stock will pay a dividend of €4 in 1 year, €4.20 in 2 years, €4.50 in 3 years, and then you will sell the stock. The stock will be worth €150 at the end of the 3 years, and you want a 14% return. So this is an example of what you estimate the intrinsic value of the stock to be by summing up the present value of the future cash flows. Now, if you've done a good job on the chapter on debt securities, you'll notice that this value is very similar to how we calculated the price of the bond. Okay. Anyhow, so you can see here, how do we calculate the estimated stock value? Where we're taking the present value of all the future cash flows. Present value equals cash flow divided by 1 plus I, or R, depending on the nomenclature, to the N. So the $4 dividend in 1 year. So you're taking this is the present value of $4 in 1 year using a 14% discount rate. This is the present value of €4.2 in 2 years using a 14% discount rate. And then you can see in 3 years you're receiving not only the dividend, but you're also assuming that you're selling the shares. Okay, so at the end of 3 years you're receiving the €4.50 dividend, and you're discounting it at 14% for 3 years, and you're selling the stock for €150 in 3 years. You're discounting it back. Sum up the present value of all the future cash flows, and you get an estimated stock value of €111.02. Okay. Now again, you don't need to know this, but I'm just going to show you how to do it on the calculator using, not in this case, it's not the time value of money functionality that we use to calculate the price of the bond. In that case, the coupon payments were always the same, so we were able to use this functionality. So remember, going back to the bond, we have our N, we have our IY, which is our market discount rate. In this case, it's 14%. We're calculating the present value for the price. For the bond, the payments was the coupon payments, and the future value was the face value, the par value. In some cases was $1,000, and the periods per year. It was semi-annual payments on a bond, and so we were able to use the time value of money functionality because the payment was the same. Now in this case, the dividends are changing, so there's a different functionality on the calculator, and it's cash flow. So if we click on the cash flow and we want to clear any previous work, we do second and we clear the work. Click on the cash flow. Cash flow 0. This is what we're going to calculate. So we're going to arrow down. Cash flow 1 is that first dividend. It's €4. So we're going to hit 4, enter, arrow down. This is the frequency. It's only one dividend for that year. The cash flow number 2 is the €4.20. So 4.2. We enter, arrow down. That's only that dividend only happens once at €4.20, frequency once. Arrow down, and we get to the third cash flow. Don't forget, it's not only the dividend, but also the assumption of selling the price stock for €150. So that would be 4.5 plus €150. Hit enter, equals €154.5. We're going to hit that enter. That frequency, of course, is only 1. So pay attention here. Now I'm going to use the NPV key, and the interest rate, you want a 14% return. So I'm just going to click 14, hit enter, arrow down, and this is when I compute. So I'm calculating a stock price of €111.02. Move that aside, and ta-da, there we go, estimated stock value 111 euros.02. Again, that's a nice to know, not a need to know. You don't have to know how to use the financial calculator. But again, I find, I like to build up people's skills. And I find if you understand how to do it, you see another example. Anyhow, you learn by doing. So it's above and beyond the call of duty for the exam. But it's a nice to know, not a need to know. But I think it's fairly easy to understand, and it's quite important as you progress to higher levels. Okay, I'm not going to spend a lot of time on this slide, but this is from the previous chapter, Chapter 9 on fixed income securities. If you haven't seen the video, go back and look at it. You can see this was the valuation of a fixed rate bond, and this was a 3-year bond, $1,000 face value, 6% coupon, semi-annual payments, discounted at 7%. And so you can see that's 3.5% every 6 months because it's a semi-annual payment. So the valuation of the bond was simply the sum of the present value of all the future cash flows. The $30 was the coupon payment, $1,000 times 6% divided by 2. And you receive those coupon payments 6 times because it's a 3-year bond. And then you got your $1,000 back. So again, I think this is why I believe that finance gets easier the further you go, because you start to see some overlap. And so again, the discounted cash flow approach to valuing stocks is really no different than the valuation approach that we used for the price of the bond, and that's being built up on the foundation that we learned in the quantitative concepts, that the present value equals the future value divided by 1 plus r to the n. Okay, and we see different nomenclatures. Sometimes instead of future value, we see cash flow. Instead of r, we see I. Instead of PV, we see V naught, valuation at time 0. Okay, but again, the discounted cash flow concept at this point should not be too difficult. Okay, we're down to the last learning outcome statement for this chapter. It's learning outcome statement E, which is describe company actions that affect the company's shares outstanding. And there's 6 things that we're going to be looking at here: initial public offerings, seasoned or secondary equity offerings, share repurchases or buybacks, stock splits and stock dividends, exercise of warrants, and acquisitions and spin-offs. Okay, so companies undertake major changes as they grow, evolve, mature, or merge with another company. Some of these changes result in changes to the number of common shares outstanding, the number of common shares currently held by shareholders. Various corporate actions can affect equity outstanding. Selling shares to the public for the first time, conversion from a private company to a public company, is referred to as an initial public offering, an IPO. We can look at many different examples of IPOs if we want to in many different countries. Okay, selling shares to the public in an offering subsequent to the IPO is referred to as a seasoned equity offering or a secondary equity offering. Buying back existing shares from shareholders is referred to as a share repurchase or a share buyback, and we've we can see examples of that in various markets around the world as well. Issuing a stock dividend or conducting a stock split, for example, issuing 1 share for every 2 shares owned by shareholders, is an example of a stock split, okay, or reverse stock split. We've also saw previously in this video issuing new stock after the exercise of warrants. And there may be examples where a company issues new stock to finance an acquisition. Creating a new company from a subsidiary is a process referred to as a spin-off. Okay, so all these things can affect the equity on the balance sheet. Equity investors are affected by changes in the number of shares outstanding. Therefore, it's important for equity investors to understand how these changes affect the value or ownership claim of their equity investment. And basically what they're talking about there is dilution. Some of these actions that affect equity outstanding results in dilution. Your proportionate share of the company has gone down. And in some cases, some of these company actions do not result in dilution or your proportional ownership in the company being affected. Okay, a stock split would be an example of we're going to see later on. That doesn't affect your proportionate ownership. Okay, it just affects the number of shares that you own. So now we're looking a little bit more detail at the IPOs, initial public offerings, And the main difference between a private company and a publicly traded company is that the shares of a private company are available only to select investors and are not traded on a public market. Another thing to realize is that when a company becomes public, their financial statements are public. A private company is not obligated to share their financial information with anyone outside of the company. A private company becomes a publicly traded company through an IPO, initial public offering, which is the first time that it sells new shares to investors in a public market. Private companies become publicly traded securities for a number of reasons. Number one, it gives the company more visibility, which makes it easier to raise capital to fund growth opportunities. It also helps to attract talent, raise brand awareness, gain credibility with trading partners. In addition, it provides greater liquidity for shareholders wanting to sell their shares or buy additional shares. At or after the IPO, some of the original shareholders may choose to sell some of their shares. The fact that the shares now trade in a public market makes the shares much more liquid and thus easier to sell. However, some of the disadvantages to being a public company are increased regulatory and disclosure requirements. As I said, you're now going to be regulated by the markets, and you've got additional disclosures in terms of your financial statements. The fact that IPOs are also rather expensive, it means that their costs can be as much as 10% of the proceeds. Okay. Now we're moving on to seasoned or secondary offers, and after an IPO, publicly traded companies may sell additional shares to raise more capital. The selling of new shares by a publicly traded company after an IPO is referred to as a seasoned or secondary equity offering. So again, we're looking at the language here. We're learning the language of equities. A seasoned equity offering typically has far lower costs associated with it compared to the IPO. So for an existing investor who does not buy additional shares in the seasoned equity offering, the increase in shares outstanding dilutes that investor's ownership percentage. So that's something to understand how you're affected. You own some shares of a company. Now they're offering more shares to the public through a seasoned offering. If you don't buy additional shares in that offering, then your ownership percentage is going to be decreased. We say it's going to be diluted. Now we're moving on to share repurchases. Okay, companies may choose to return cash to shareholders by repurchasing shares rather than paying dividends. Okay, so companies got a lot of cash on the balance sheet. Again, you can pay dividends to common shareholders. That'll decrease retained earnings. Asset goes down, cash goes down. So equity is going to go down, retained earnings is going to go down because assets has to equal liabilities plus equity. Okay. Now, however, companies, cash may go out of the company by buying shares. Again, it's going to have the same result: decrease in cash, decrease in asset, decrease in equity because the shares are being repurchased by the company. That's called treasury stock. Okay. Anyhow, assuming that the company's net income is unaffected by the repurchase, the share purchase will increase the company's earnings per share because net income will now be divided by a smaller number of shares. So that's one of the implications of doing a share repurchase. Earnings per share is going to increase. Repurchase shares are either canceled or kept and reported as treasury stock in the shareholder's equity account on the company's balance sheet. Now, we won't get into it, but treasury stock, so it's kept as treasury stock, but they don't have any voting rights, okay? And treasury shares are not included in the number of shares outstanding. To buy back shares, a company can buy shares on the open market just like any other investor, or it can make a formal offer for a repurchase directly to the shareholders, okay? For an existing investor who does not sell the shares, the decrease in the number of shares outstanding effectively increases that investor's ownership percentage. So if it was a situation where it was an optional share repurchase and you didn't sell your shares back and other people did, that would effectively increase your ownership percentage. Anyhow, one of the questions that they can ask is that share repurchases and dividends are very similar because it's cash that's being returned to the shareholder. Okay, now we're moving on to stock splits and stock dividends. Okay, companies may on occasion conduct stock splits or issue stock dividends. A stock split replaces one existing common share with a specified number of common shares. It increases the number of shares outstanding, but does not change any single shareholder's proportion of ownership. A stock dividend is a dividend in which a company distributes additional shares to its common shareholders. Although there are slight differences in the accounting entries for stock splits and stock dividends, they essentially are the same transaction. When a company splits its stock or issues a stock dividend, the number of shares outstanding increases, and additional shares are issued proportionally to existing shareholders based on their current ownership percentages. Okay? So the overall value of the company should not change. So the price of a share should decrease, but the value of any single shareholder's total shares should not change in value. Okay? So given that stock splits and stock dividends do not have any effect on company operations or value, why do companies take these actions? One explanation is that as a company does well and its assets and profits increase, the stock price is likely to increase. At some point, the stock price may get so high that shares become unaffordable to some investors and liquidity decreases. Now, one of the things when you look at stock trading, a board lot is often 100 shares. So as stock prices become, they trade in board lots of 100 shares. If it's not 100 shares, it's an odd lot, and odd lots have less liquidity. So as stock prices get very high, there sometimes becomes less liquidity. So by doing a stock split, you'll increase the number of shares outstanding, you'll decrease the price, and you'll increase liquidity. That's the theory, okay? So a stock split or stock dividend will have the effect of lowering a company's stock price, making the stock more affordable to investors, improving liquidity. Now, companies with very low stock prices may conduct a reverse stock split to increase their stock price. The primary reason for a reverse stock split is that the company may face the risk of having its shares delisted from a public exchange if its stock price falls below a minimum level dictated by the exchange, okay? So, for example, if a stock is about to become a penny stock, it'll be delisted. The company could do a reverse stock split, and that will increase the stock price, okay? So for like 10 shares outstanding, it may be converted to 1 share, okay? That's a reverse stock split. A reverse stock split reduces the number of shares outstanding, but does not affect a shareholder, again, does not affect a shareholder's proportional ownership of the company. So this slide is, again, just looking at an example of a company that has 24,000 shares outstanding before a stock split, and they're going to do a stock split where for every 2 shares outstanding, you now have 3, okay? So you can see if I just bring up the calculator here, there's 24,000 shares initially outstanding, 3 shares for every 2, so times 3 divided by 2, we're going to have 36,000 shares outstanding after the split. Now, before the split, there's 24,000 shares outstanding. They're worth 75 euros, so the worth of the equity was 1.8 million euros. Now, if I take that 75 euros and I divide by 3 and then multiply by 2, you can see the stock price is going to go down to 50 euros each. And if I multiply that by the 36,000 shares outstanding, the higher shares outstanding, I'm back to the 1.8 million equity. And again, the way that I like to sometimes explain is assets equals liabilities plus equity. Nothing happened to the A, folks. There was no cash that went out. A didn't decrease in terms of a cash dividend or a share buyback, okay? This is simply a stock split. So if A didn't change, E didn't change. If it was 1.8 million euros in equity before the split, it has to be 1.8 million euros in equity after the split. So what happens, you've got more shares outstanding, but the worth of the shares goes down, okay? That's the result. Number of shares increase, but the price drops, but the total value is unchanged. Now over here, if we look at the company could also issue a 50% stock dividend, and you can see that would result in 36,000 shares outstanding, and again the price afterwards is going to be 50 euros. So I put here in bold green, a stock split or stock dividend does not change a shareholder's proportional ownership of the company. It doesn't change the value of the equity. It does change the number of shares outstanding. It does change the market price, okay? So we're down to the last slide with content for this chapter, and we're going to just finish the video with 2 practice questions after this. So now we're looking at some other actions that affect the shares outstanding, and in this case we're going to look at the exercise of warrants, acquisitions and spin-offs, and how they affect the shares outstanding. Okay, so companies that issue warrants as a form of additional or bonus compensation to employees may have to increase the shares outstanding if the warrants are exercised. Given that there may be numerous employees who exercise warrants on a recurring basis, companies who issue warrants to employees as a form of compensation will typically experience some increase in shares outstanding every year. To mitigate the dilution effect on existing shareholders, some companies may repurchase a small amount of shares each year to offset the additional shares issued when warrants are exercised. Okay. On occasion, another action is on occasion one company may acquire another by agreeing to buy all of its shares outstanding. When an acquirer purchases a company, all of the outstanding shares of the acquired company are redeemed for either cash or for stock in the acquiring company. In some cases, the transaction may be financed with a combination of cash and stock. If the company being acquired is small and the acquirer has sufficient cash, there is no need to issue new shares. However, for larger acquisitions, the acquiring company may pay for the purchase by issuing new shares. The amount of new shares depends on the purchase price and the ratio of the two companies' stock prices. An acquisition in which the company uses its stock to finance the transaction results in an increase in the acquiring company's shares outstanding. For existing shareholders in the acquiring company, the increased share count effectively dilutes their ownership percentage. Shareholders of the acquiring company and the target company are typically asked to vote on a proposed acquisition. Moving on now to spin-offs, a company may create a new company from an existing subsidiary in a process referred to as a spin-off. Shares of the new entity are then distributed to the parent company's existing shareholders. After the spin-off, the value of the shares of the parent company initially declines because the assets of the parent company are reduced by the amount allocated to the new company. But shareholders receive the shares of the newly formed company to compensate for the decrease in value. A company's management may conduct a spin-off in an effort to try to create value for its shareholder by splitting the company into 2 separate businesses. The rationale behind a spin-off is that the market may assign a higher valuation to the 2 separate but more specialized companies compared with the value assigned to these entities when they are part of the parent company. So we're just going to finish this video with 2 practice questions out of the learning ecosystem. Both are at the expert level, and they'll show you that at the expert level, yes, sometimes you need to roll up the sleeves and do a little bit of studying and practice. Anyhow, the first question is, from the firm's perspective, the corporate action that most likely will have the same effect as paying a cash dividend is a stock A, split, B, buyback, or C, dividend. And the correct answer is B. From the firm's perspective, the corporate action that most likely will have the same effect as paying a cash dividend is a stock buyback. Stock buyback is similar to a cash dividend because the company still distributes cash. However, shareholders receive the cash only if they choose to sell their stock back to the firm. A is incorrect. A firm does not make any cash disbursement to the shareholders with a stock split. Also, with regards to a stock dividend, a firm does not make any cash disbursements to the shareholders with a stock dividend. And the last practice question from the learning ecosystem, classified as an expert question, is dilution can be caused by A, stock split, B, stock dividend, or C, a seasoned equity offering. Okay, the correct answer is C. Dilution can be caused by a seasoned equity offering. A seasoned equity offering can create new shares in a manner that changes the proportional equity ownership of individual shareholders from what it was prior to the offering, and that's dilution, okay? A is incorrect. A stock split does not affect the proportionate equity ownership of individual shareholders, and a stock dividend does not affect the proportionate equity ownership of individual shareholders. So you can be sure you're going to be tested on the exam, almost 100% probability, I would say, on a question regarding dilution and what type of corporate actions result in dilution and which ones may not. So that's an important area to focus on, with regards to the chapter. And that's the last slide for this chapter. And that is the conclusion for this video on Module 4, Investment Instruments, Chapter 10, Equity Securities for the CFA Institute Investment Foundations Program. Thank you.